Charlie Munger suggests on how to invest during a recession. Charles Thomas Munger is an American billionaire investor, businessman, and former real estate attorney. He is the vice chairman of Berkshire Hathaway, the conglomerate controlled by Warren Buffett. Buffett has described Munger as his closest partner and right-hand man. Munger was the chairman of the Financial Corporation from 1984 to 2011. He is also the chairman of the Daily Journal Corporation in Los Angeles, California, and a director of Costco Wholesale Corporation. Charlie Munger spoke extensively about his predictions for the economy, inflation, global political dangers, and currencies this year at meetings and in interviews. So, let us have a look on Charlie Munger's suggestions on how to invest during a recession. According to Charles Munger, they'll never die. You can't. The idea of getting more value than you pay for. That's what investment is. If you want to be successful, you have to get more value than you pay for. And so it's never going to be obsolete. Now, you can get a whole body of people that don't even know what they're buying. They just code quotations on a ticker. I don't think it's helpful to have. Think of the past crazy booms and how they worked out. The South Seas bubble, the bubble in the late 20s, and so on and so on. Munger believes the stock market has devolved into a speculative casino of gambling. With many stocks decoupled from underlying stock values, this is what causes bubbles to burst. The Consumer Price Index for all urban consumers rose 0.4% seasonally, adjusted in September, and 8.2% year-on-year. In September, the index for all items excluding food and energy increased by 0.6%. It is up 6.6% year-on-year. The US inflation rate is the percentage increase in the price of a selected basket of goods and services purchased in the US over a year. Inflation is one of the metrics used by the US Federal Reserve to assess the health of the economy. Since 2012, the Federal Reserve has set a 2% inflation target for the US economy and has threatened to change monetary policy if inflation does not fall within that range. During the recession in the early 1980s, inflation was particularly high. Inflation rates reached 14.93%, prompting the Federal Reserve, led by Paul Volcker, to take dramatic action. The Federal Reserve raised interest rates by 0.75 percentage point on Wednesday, the fifth hike this year in the central bank's crusade to contain inflation. More rate hikes, according to Fed Chair Jerome H. Powell, are likely, and they will hurt, slowing growth and weakening the labor market. Unfortunately, there are no other viable options. Inflation must be controlled. Mr. Powell emphasized that Americans are already feeling the effects of rising prices, with low-income people bearing the brunt of the burden. Higher prices for necessities such as food are eating into wage growth. If the country's leaders do not address the problem now, it will only worsen and become more difficult to solve. I wish there was an easy way to do it, Mr. Powell said. The Fed provided a roadmap. Following significant rate hikes, the central bank now forecasts that the economy will grow by 0.2% this year and 1.2% next year. The unemployment rate is expected to rise from 3.8% this year to 4.4% in 2023. Mr. Powell has warned that the United States could enter a recession. However, the Fed expects inflation to fall significantly, preparing the country for long periods of sustainable growth in the future. Charlie Munger has discussed his outlook on the economy's future. He discussed his views on the economy, oil, renewable energy, and cryptocurrency following his recent personal investment in an Australian investment company. Billionaire investor Munger, who has worked alongside Warren Buffett for decades, spoke with the Financial Review in Australia about his thoughts. "I'm always aware of it, but it doesn't stop me from operating," he said. "I'm 98 and a half years of age and I've seen a lot of inflation. I intend to live through inflation. I've lived through a lot of it already in my long life. It doesn't discourage. In the end, if you end up printing too much, you end up like Venezuela." Charlie Munger, a billionaire investor, said Monday that political leaders in the United States and Europe should not press central banks to lower interest rates. "I'm so afraid of a democracy getting the idea that you can just print money to solve all problems. Eventually, I know that will fail. You don't have to raise taxes, you just print." Munger added that he did not believe the United States was in such a situation, but that it is dangerous when a democracy believes it can print money to solve all of its problems. In his most recent brazen attack yet on the Federal Reserve, American president called for the central bank to cut interest rates by 1 percentage point and implement more money printing quantitative easing. President has expressed concern that high interest rates will harm economic growth during his presidency. The call for rate cuts comes despite another strong first quarter economic performance. After many economists predicted little or no growth ahead of this release, GDP rose at a robust 3.2%. The Fed voted last week to keep interest rates steady. In the same interview with Munger on Monday, Buffet responded, "I could not conceive of a world where you would have full employment, 5% budget deficits, and have a long bond at 3%. The Federal Reserve is America's central bank. Its job is to manage the US money supply, which is why many people say that the Fed prints money. However, the Fed does not have printing press that produces money. Only the US Treasury Department has the authority to do so. However, the Fed has a plethora of other monetary powers. The majority of money in circulation is not in form of cash. Credit is added to bank deposits. It's similar to the type of credit you get when your employer deposits your paycheck directly into your bank account. When people say the Federal Reserve prints money, they mean it adds credit to the deposits of its member banks. The Fed typically requires banks to hold 10% of their deposits in reserve. This reserve requirement was reduced to zero in March 2020 to combat the recession caused by the COVID-19 pandemic. Invest in cash. Investing during a recession is not as scary as you might think. In fact, it's far more manageable for people who have the money, have done their research, are patient, and pay attention. To invest, you must first have the funds to do so. This is why I strongly advise you to keep cash on hand during a recession, or ideally before the recession, so that you can invest it when the time comes. It is more important than ever to save and spend your money wisely. The more you save and spend less on non-essentials, the more money you will have to invest. It may take months or even years for the market to fully recover, but it will do so eventually. Your investments may suffer a short-term setback. In the long run, however, you are far more likely to see positive results. Buffet also advises taking a long-term approach to investing. "I can't predict the short-term movements of the stock market," he writes. "What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up." Buffet believes that temperament rather than intellect is the most important quality of an investor. A successful investor is not concerned with whether they are with or against the crowd. The stock market will fluctuate, but in good and bad times, Buffet stays focused on his goals, as should all investors. This renowned investor rarely modifies his long-term investing strategy, regardless of market conditions. Warren Buffett's longtime business partner, Charlie Munger, warned on Wednesday that the stock market is showing signs of a bubble, reflecting a dangerous mentality among some investors to gamble on stocks as they would horse races. Munger bemoaned the recent GameStop Corp mania, in which immature investors encouraged each other online to buy the gaming retailer on platforms such as Robinhood, trapping some hedge funds in a short squeeze. "It's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors," he said. Charlie Munger expressed his concerns about the current state of the markets. He made a sobering forecast for the future that investors should not dismiss. Munger slammed aggressive investors at an annual meeting of the Los Angeles-based newspaper publisher Daily Journal Corporation, of which he's chairman, comparing some of them to racetrack bettors who are buying stocks in a frenzy. And he believes that the current state of the markets is comparable to the dot-com bubble, saying, "Yes, I think it must end badly, but I don't know when. Many investments are currently overvalued, and a correction or large-scale crash is possible. That does not mean it will happen tomorrow, next week, or even in a month or two. The concept of getting more value than you pay for is what investment is all about. If you want to be successful, you must get more value than you pay for. You can now get a whole group of people who don't even know what they're buying. They just quote codes from a ticker. I don't think it's useful to have. Consider previous crazy booms and how they played out, such as the South Seas bubble, the late 20s bubble, and so on. So it's up to you to take the right decision." What do you think about Munger? Is his strategy really the right one?